rain, Saturday rain, and Sunday rain. So we got 1, 2, 3, 4, 6 days of non-stop rain.
Okay.
There you go.
All right, I hear you. I hear you. That's good.
So you shouldn't. Don't think you should have asked, really.
That's good. Anyway, well, it's our summer's coming up. Anyway, this weekend is the Prince and Princess down visiting us. I guess they're supposed to be leaving tomorrow.
Yeah,
Yeah.
I saw in the newspaper they were visiting. Yeah. Where were they staying?
They're staying at the Ocean Club, and I see there was regatta. They were sailing the Monarchy yesterday, so they were having a wonderful time.
Really? Oh, that's very nice. Yeah. You know, when you probably won't believe this, but when I first met Miguel, I actually stayed at the Ocean Club. Now, before you think I'm kind of mega rich, this is before, Mr. Kurtzner acquired the Ocean Club. And at the time, it was just a few small properties. I don't know if you can remember, on the island, and it was really cheap to stay there. I mean, it was nice, but it was really underdeveloped. And then when he got it, I mean, he's really smart. He then started to call it the one and only Ocean Club, didn't he?
Yes, he did.
So people like Keith Checkley were banned from there, and he welcomed people like Oprah Winfrey and all the others, and then put the price up and the price up and the price up. And now you've got Royals staying there. Gosh, there we are.
You gotta be a multi-millionaire to get in there, trust me. Multi-millionaire.
Yeah, the last price I heard was $75,000 a night to stay in the thing between the two twin towers.
Oh, the president. Oh, I know. Yeah, I think
it's sweet. Yeah.
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 The president. We love the president. Anyway, good morning once again, ladies and gentlemen. I sent you guys a revised, updated schedule. I think we only put a date up. So after this last class for your module.
This is module 1, the final class. Yeah.
Financial situation analysis. Yeah. We go right into module 3 coming this Thursday. Okay, so this Thursday at 6:30 p.m. we'll be starting module 3. And also, yes, please, Thursday, come and collect anytime after Thursday next week, come and collect your module 6. Okay, that's ready for you to collect. With all that done and said, I'm going to leave it over to Mr. Checkley. And if you guys need me, just give me a shot.
Yeah, how many people have we got here?
We've got about 7 persons online so far right now.
Right.
So I think we're waiting for about 4 more.
Yeah, just give them 5 minutes and then we'll start. Yeah.
Okay, sounds good. Okay, folks.
Yeah. Let me try to share my screen, Miguel, while we're waiting. Now then. That's one.
Yeah, looks good.
Yeah, but can you see this other one, the ratio analysis?
I don't see it. Yeah, I see a cash flow.
Okay, let me stop that. I need to pick up the ratio one. That's it.
Yes, sir.
Good. Okay, that's good.
All right.
Morning.
What Junkanoo law? What the Junkanoo? Morning.
Morning. Morning, Shanika. Okay, everyone, let's make a start. Can someone just confirm you can hear me okay?
Yeah, we're good to go.
Okay, thanks, Miguel. Okay, everyone, so welcome to the session 3 from module 1. So I do know it, was a little bit confusing, but that's all we could do with the clash of dates that we had. And I do hope you enjoyed Michael's 3 sessions. I've worked with Mike for many years, and he's generally a very skilled presenter, going back a long way. So if you remember what we did on module 1, we started off with financial situation analysis, where we were looking at a personal client to begin with, and then we explored, some of the key documents that we're looking for, trying to derive a personal balance sheet, and then the important personal budget, which would help us in our discussions with the client. And then we took a look at 2 case studies, the John Edwards case study, where he'd moved property, if you remember, and he'd run into some financial difficulties. I think most of us agreed that the option of a bailout would be a good idea, but we all decided that we'd have to monitor it quite closely in case, he encountered problems again. So we talked a little bit about the monitoring and control aspect. Then we looked at Jane Brown, and you remember Jane was getting divorced, and she was going to receive quite a decent dollar settlement, which she wanted to spend immediately on a timeshare. and most of us again didn't think that was a very good idea, and we thought the starting point would be better if we could try and encourage Jane to look at her personal financial situation before she wanted to, think more about the timeshare. And in any case, we didn't think a lending bank would move forward on the timeshare deal because we weren't sure about the repayment aspects and in fact whether the timeshare could actually be rented out as they were suggesting, and also the difficulty we were anticipating with the collateral being offered probably wasn't a valid security anyway. So all in all, that wasn't such a good case. Then we moved into looking at the slightly more complex areas of financial situation analysis when you're looking at a business. And very important that as financial planners, you get a good understanding of business, whether it's small, medium, large, or very large. And we started off with the clothing imports case study to try and bring our financial analysis to life. So this is where we got up to. We were starting to talk about key ratios. And I explained too, there's lots and lots of ratios that we can use, but what we've come up with over a number of years is what we believe is a significant spread of ratios that will give you an indication of how the business is performing. And yes, there'll be extra ratios from time to time that you might want to build in, but the template on the ratio sheet that we're looking at gives us those key ratios. And on the screen at the moment, you can see the definitions of them that we had, running right through there, and then moving into the case study. Now if you can find your notes of where we got up to, that will obviously help. Here's the summary ratio sheet. And what I'll do is I'll read out the ratios that we have so far from our calculations, and then I'll ask if someone can confirm that, and then we can continue with this. But from what we saw so far, you remember on the sales and profitability side, it wasn't particularly good news. So we had sales growth in the second year, because the first year we can't calculate that because we don't have the preceding year. So in this year here, we had 16.7% and then 23.8. Anyone confirm that, please? 16.7 and 23.8.
That's correct.
Thank you. Well done. And then gross profit margin was 10%, 8.9, and then 7%.
Correct.
Correct. Thank you. And we were quite worried about that. So because the sales growth looked good, but the problem is the gross profit. So that's the profit, which when we think more in terms of the performance of the business, you can think of gross profit as the contribution. In fact, a lot of American analysts would use that term. They would call it the contribution margin. And I quite like that. I don't like some of the American terminology, as you probably gathered already. But I think at that point, the contribution margin is quite a good term, because it's the contribution that's left towards, the overhead costs of the business, and then any finance costs as well. So that's a good thing to look at. And it is one of the ratios, one of the few ratios actually, that you can compare quite successfully with businesses in a similar sector. And also you can do cross industry comparisons as well, as I was mentioning. So with an importer, this gross profit margin is going to be quite small, generally speaking, because he's importing the clothes and then he's on-selling them to retail stores. So he's kind of the man in the middle there. So 10, 8.9 and 7%, quite a worrying deteriorating trend. Then we worked the operating margin, 3.7, and we didn't do the other 2 years, so we'll do that in a moment. And then pre-tax profit margin, 2.8. And then we did do the net profit margin, 1.9, 1.5, and then a dreadful figure of 0.1%. So Nikita, since you seem to be quick off the mark this morning, can you confirm those net profits? 1.9, 1.5, and 0.1. Okay, so net profit, very important. It's the bottom line position, which Miguel always loves to go on about. And of course, it's very, very important. Whatever business that you're looking at, what is the bottom line net profit position? And if we equate it to $100 of sales, for example, we could be in discussion with the client and we could say, if he wasn't kind of getting the picture of what we're trying to put over, I've always found it quite good to equate it to, £100 of sales or $100 of sales. So for every $100 of sales in year one, he was actually generating, $1.90 bottom line net profit. So that's quite fine to begin with. But then in year two, despite the fact that sales have increased by 16.7%, in year two, he's generating $1.50. And then the really bad news in year three, when actually sales go up by a very significant, almost 24%, his net profit, I'm hoping we got the decimal place in the right place, but it looks like just 10 cents out of every $100, 0.1%. Everybody okay with that so far?
Yes, that's correct.
Excellent, excellent. So we can see that the profitability, although the sales are increasing significantly, profitability is declining quite significantly. And we need to have ideas about what we could discuss with the clothing case study. Now, the next section are the traditional accounting ratios of working capital, current ratio, and quick ratio. And yes, these are important to do, but they've kind of slightly paled in significance, relative to some of the other ratios that we're going to see in a moment or two, because they are, like balance sheet snapshot positions, and we have to get behind the figures. So for example, working capital, we got $35,000, $53,000, and then 52. And then the current ratio, which was the current assets divided by the current liabilities, 1.1 to 1, 1.2 to 1, and 1.1 to 1, not much significance there. And then the quick ratio, 0.6, 0.6, and 0.5. So yes, we still work these traditional ratios here, but I think you'll agree with me when we've done the next section that these are more powerful in terms of the work that we're trying to do in understanding the business and how it's actually trading. So let's take a look at the first of these, which is the debtors, or if you prefer the term, receivables calculated in days. So let's go back to how this is calculated. And there it is, ratio number 4 on page 7. Everybody see that? So it's debtors divided by sales multiplied by 365 will give us an indication of the receivable days on hand or the debtor collection period. Now, this is a very important ratio, the same as the next one, which is the stock turnover or the inventory turnover, and the same as the next one, which is the payment to the trade creditors. So these three ratios are really key ratios, as we'll see, in terms of the cash flow patterns of the business. So let's have a look at those and make those calculations. Now this is where it gets a bit tricky, as we saw before, because we'll be flipping between the balance sheet and the income statement this time. So let's have a look at that first calculation. So we got debtors in year one. You're welcome, 150,000. So if you put that into the calculator and divide 150,000 by the sales figure, which we have on the next page. Yeah, there's the sales, 900,000. And then we multiply that by 365 to get it into days. So I make the debtor collection period at 60.8, but in the real world, you wouldn't like put points in when you're talking about debtor collection or inventory or the payment to supplier credit. So what we can do is round that up to 61 days. So 61 days for the debtor collection in the first year. So what I'll do is I'll do the stock and the creditors with you. Then I'll ask you to do years 2 and 3 and we'll compare notes. So let's take a look at the stock. So let's say what the stock calculation is. Now there's a few ways of doing this, but the way we're doing it within this program is to take the stock and divide it by the cost of goods sold and multiply by 365. So let's take a look at that. So we get the stock from the balance sheet. So there's the stock in the first year, 135. And we're going to divide that, we have to be careful here, by the cost of sales, which is 810,000. And then multiply that by 365. And by coincidence, I get 61 days, the same as the debtor days. Anyone confirm that?
That's correct.
Thank you. And then the third of these three very important ratios are the business paying their suppliers, paying their trade creditors. So let's look at this calculation. So this calculation, we're recommending you take the trade creditors, again divided by the cost of goods sold, and multiply by 365 will give us the payable days on hand or the creditor payment period. So into the balance sheet again. There's the creditors, look, 140,000. And then we're going to divide that by cost of sales again, which you might have memorized as 810, and multiply by 365. And I make that 63 days to pay the suppliers. Someone confirm that?
Confirmed.
Excellent, thank you. Okay, so I'll just give you a couple of minutes to work the debtor days on year 2 and 3, the stock days on year 2 and 3, and the creditor payment days on 2 and 3, and we'll compare notes on that just to make sure you're on solid ground here. So whoever's finished first, if you could just put the figures into the chat box and then we can verify them in there. So we're looking for debtors years 2 and 3, stock years 2 and 3, and creditors years 2 and 3. So Ernst put in 69 days and 93. Can we just check that 93? It sounds a bit high. So it's 230,000 of debtors. Divided by the sales in year 3. 1, 3, 2. Yeah, I'm not sure about that, Ernst. Has anyone else got some
I got
figures?
59 days.
Yeah. What did you get?
59 days for year 2, the debtors.
Yeah, I don't agree the 69. I don't agree the 93. Ernst, let's just check the calculation. So it's the debtors from the balance sheet and then divided by sales and then multiplied by 365. So who was speaking there?
The Shakira, I got
Shakir.
59 days for year 2 and
Uh-huh.
65 days year 3.
Okay, I can confirm year 365. Anyone confirm the 59 for year 2? Someone's coming in. Okay, thanks, Nikita. So when you say you got the same, was that 59 and 65? Okay, anyone got the stock days yet? So stock days would be stock divided by cost of goods sold and multiplied by 365. $72 and $78 were offered by Nikita. Anyone confirm that?
That's correct.
Excellent, well done. 72 and 78. And then finally, the
Well, I
pay.
rounded 72. I rounded it to 73. I got 70.5.
Okay, right. 73 and 78. And then the payables, another important ratio. Okay, and it's coming in on the creditors this time. 69 and 85. Let's see if the ladies agree with you this time. Yes, from Colleen, that's good, thank you. So we got creditor days, 63 in year one, then 69 in year two, and 85 in year three. Okay, now if we just stop for a moment and kind of draw breath on those. So what is it we're actually seeing here? Well, what we're seeing, going on to the summary sheet there, is when we looked at the traditional kind of accountancy textbook approach, on the working capital, it didn't really give us much of an indicator, except it was 35,000 and then it looked as if it improved to 53,000 and then stabilized at 52. And the current and quick ratios didn't really give us a lot of indications. I mean, that's my interpretation of it, which is why I would suggest to you, in our work as financial planners, when we're looking at business, we need to get a bit closer to these ratios here, because these ratios, we've calculated those. We got 61, 59, and 65 for the debtors. The stock 61, 73, and 78. And the payments to the supplier credit 63, 69, and 85. Okay, now I'm going to ask for someone to volunteer the comment on that. Are these figures getting better, or are they getting worse, or aren't we really sure? So would someone like to speak, put the microphone on and give us their opinion? Oh, Nikita, you can't do that because your mic's not working, but you could put your opinion in the chat box if you so wish to do so. So what do you think? Is 61, 59 for collecting in the receivables, and then 65? Is that a good trend or not? Start with the debtors. Anyone going to be brave and volunteer a comment? When you're looking at ratios, quite often it's quite a good idea to, imagine you are the business person. So let's imagine, we are the business people and we're running clothing imports. So what's this figure telling us? Well, debtor collection, debtors are the people who owe money to clothing imports, yes? So that's the debtor position. Just the same as when you're working, within the bank, if you're putting out loans to customers, effectively they are the bank's debtors because you're trying to collect these monies in. So the debtors in the business, they're people who owe clothing imports. So what we've discovered is in the first year, he's collecting his debtors in, his receivables, if you prefer the term, in 61 days. That's just fractionally over 2 months. And then it's 59, which is slightly better actually, but then it goes out to 65. Now we've got a comment come in here, not a good trend. It's taking him longer to receive money over the years. That's quite correct. So what we're seeing here is there's a slippage. I mean, I know it's not a huge slippage because it's gone from 61 year one to 65, but it's over 2 months to collect the debtors in. And when you're in discussion with a client and you're maybe working a few figures out, what would be a good question to ask, do you think, on this debtor collection, on this receivable collection? Any ideas what would come up in the conversation if you'd done this ratio and you've seen the figures? and Nikita's telling us it's not a good trend, it's taking him longer to receive the money. So what would be a good question in the conversation with this client, building up on some of the work you were doing with Mike Hill on the relationship management side?
The first question I would ask him is, what is his strategy for collecting debt?
Yeah, very good. And what do you mean by that exactly, Ernst? Because if I'm the business client and you ask me what's my strategy, I'm not too sure I know what you mean. Can you make it a bit more straightforward of a question?
Sure.
I'm
So I would ask him.
I'm not being difficult, but you see, Mr. Clothing might well be an out-and-out salesperson, because you've seen the strong salesperson, but he might not be, that knowledgeable about other areas of the business. So here's another one, yes. So Ernst, we'll finish with Ernst, and then we'll take a look at Nikita's comment in the chat box. So yes, what were you going to ask me, Ernst, before I rudely interrupted you as a customer?
Right. So from my experience, I noticed that persons who are good at sales aren't good at collecting.
Very good comment.
So I would ask him in terms of his strategy.
Yeah.
At what point is he starting to engage and having conversation with his debtors?
Yeah.
Is he starting too late, or is he starting? Is he not engaging with them at an adequate time, or it may be a position where if he can't effectively collect the debt, maybe outsource it.
Yeah, because as you say, quite well, we shouldn't say generally, because what we could say though is based on our experiences, and I would share your experience, that often salespeople aren't very good at the data collection. Oh, now here's a brilliant question just come in. Also, what are his collection terms? Now that's what I've also been hoping for, because when we look at the data collection, just the same as when we're going to go on to look at the creditor payments, a key, absolutely key question is to look at these figures, see what the trends are, ask the sort of questions that Ernst's coming up with, but also to find out what's the terms of trade. What's his contractual terms. Now, if he says, oh, well, I give the stores who I supply to, I give them 30 days credit, well, then it makes the figures look even worse, doesn't it, Ernst? Because even in his best year was 59 days on a 30-day collection. But if he says to you, oh, our collection terms with the stores have been agreed at 60 days, well, then you can see it's going to change our perception quite slightly, because we've got this extra fact. So if the collection period agreed is 60 days, and he's collecting in 61, 59, and 65, well, that changes it, doesn't it? It doesn't look so bad now. So that's why we always have to try and get in behind the figures, and build up the conversation. So very good question. So if it is longer, it's not bad. That's quite correct. Very good observation. So well done, everybody. Now, what about the stock? So let's look at the stock days. And we got 61 days, 73 days, and 78. So is that good or is it bad? Remember what he's dealing in. He's dealing in clothes. Anybody got views on that? I'm sure you have. Either via the mic or via the chat box, whichever you prefer. Come on, Ernst, we'll get you on the spot again. So the stock days are 61, 73, and 78. Good or bad?
I would say it could be better, but I wouldn't say it's bad.
Well, we have to be careful how we come at this one. If I transported you to Eastern Europe, this trend would be perceived as good because the business has got more stock. But generally in the Western Hemisphere, that's bad, because what we're seeing is a build-up of stock. So he had 2 months stock, then he had, 73 days of stock and 78 days of stock. So what sort of question could we ask? We could ask a question about the strategy again. So what's your strategy for the stock? The inventory is not moving is the comment that's come in. And if the inventory is not moving as quickly, what sort of question could we ask building up on the discussion? What are we trying to get at there? Well, look at the paragraph following, etc., etc. As the name suggests, it's a merchant engaged in some import, subsequent wholesale of ready made up fashion clothing. Okay, fashion clothing. So what could we be quite worried about in the inventory?
Maybe he's not changing his his fashion to like up-to-date fashion or
Exactly, yeah. So what we're trying to get at here, very good, is some of this inventory, is some of the inventory actually out of fashion?
out of fashion, yeah.
Yeah, or is some of it maybe, damaged goods,
Mhm.
possibly? Antiquated's a
Like
comment
the
just come in. Yeah,
the quality may not be,
yeah, the quality
as
might,
it was at the beginning of the inception or when he opened up.
exactly, yeah, the quality might be slightly defective. So again, it provokes, these things provoke a lot of discussion, which is the power of doing the ratio analysis. Now, when I was in the corporate division of Barclays all those years ago, there was probably about half of our branch managers wouldn't do this type of analysis until after they'd met with the customer or after they'd gone to the business. Now, we used to encourage them very much to do this type of analysis before the meeting, and particularly if they were going out on a site visit, because if you'd done these ratios here and you've got that stock figure, when you go to the business, you've got a really good mission to have a look at that inventory, yeah, and discuss with them, and when I did this in Jamaica, first did this case in Jamaica a long time ago, the true stories are always the closest to heart, and it was face to face. So there was like the U shape, people all sitting around, and there was a lot of Jamaican men on the program, and I said, oh, well, maybe clothing imports, he's got a lot of jeans, and the jeans are right out of fashion because they've got the wide bottoms, around their ankles. They've got the wide bottoms to the jeans. And I thought people would laugh, but they didn't. And then I looked and I could see under the tables, and a lot of the men, the Jamaican men in the room, had, guess what, jeans, with the flared bottoms. So I had to quickly say, well, of course, now they're moving back into fashion in the UK, so the straight legs are going out and all this. Yeah, goodness me. These comments can get you into quite a bad shape. So yes, some very penetrating, good questions there on the stock. So the payables, this is his payments to the suppliers, the suppliers from the Far East, and then more recently, the suppliers from London and the UK. So it's taken him 63 days to pay suppliers, 69, and then 85. So what's the key question again straight away?
Question I would ask is his cash flow. Is he having cash flow challenges?
Exactly, because it looks as if he could be, because it's taking him much longer to pay his suppliers. But the other thing I was looking for was, Colleen's earlier comment that what's the terms of trade? Yeah. So what's the terms of trade in terms of his payment to his suppliers? Very, very important in each and every business you get into discussion with. So if he says, oh, yes, the suppliers give me 60 days credit, well, 63 days to pay isn't too bad. 69 days to pay isn't too bad, but 85 days, that's kind of stringing out the suppliers quite a bit, which might make the suppliers feel quite uncomfortable. And don't forget, this is not an academic exercise, because if the suppliers get really unhappy with the business, they might stop supplying the business, and if they stop the supplies, there's no business, is there? So it's a very important figure to look at. So what question would you want Ernst to ask Mr. Clothing in terms of his payments? You probably say, well, I've asked it already. Is he having cash flow problems? Okay.
Well,
Yeah.
well, do you think
Yeah.
that can be the reason why maybe his clothing is starting to like go out of trend because he's taking longer to pay suppliers, so therefore his the inventory, it isn't I guess moving with the like up to date.
Yeah.
So
Yeah, that could be very, very true, that his suppliers, the inventory is not up to date. So a lot of it hangs around the inventory position. But can you see the power of those three ratios? And if you want to make a note, if I was going to a business and I wanted to start off somewhere, generally I would like to have a look at these figures, because these figures are very important, as Ernst mentioned, in terms of the cash flow. So on cash flow, if you think about it, on the trade debtors, if it's taking him longer to collect his money in, that's going to have a bad impact on cash flow. If he's turning his inventory over, his stock over slower, that's going to have a bad impact on the cash flow. And then the result could be, as Ernst suggested, that he's paying his suppliers slower because he's got a cash flow issue. So these are some ideas that's coming out from this ratio analysis. So backtracking on the two sections that we've done so far. Someone has a question there? Or an observation? Yeah.
But this business is so interesting because his revenue he is turning inventory over slowly.
Yes.
He's collecting his debt. It's not collected in a timely manner, but
Yeah.
if you look at his sales, he is actually increasing
Yeah.
in sales.
Yeah, exactly.
So obviously, it's so weird. Obviously, there's some internal issues he has to deal with.
Yeah.
And I believe Mr. Clothing might have a chance. I honestly do.
He might have a what?
He might have a chance because the revenue isn't the problem. His revenue is increasing. So he needs to deal with all of these other issues. And I think Mr. Clothing could make it.
Now who's
And like
speaking?
I said, go online. Go
Who's-
online.
Oh, yeah.
Transform the business.
Who's
Get a
speaking?
new supplier. Get a new supplier. Go online. I
Who's-
think I could help Mr. Clothing.
Yeah, who's speaking at the moment, please? I can't see you.
That's Katura. My name is
Oh, yes, Katura. It's up now, yes. Thanks, Katura. Yes, now I'm thinking back to when we first met a couple of weeks ago, 3 weeks ago. I think you said that at the time, didn't you, when we first started to look at the trends of the sales growth and the profit margins? Yeah. Yeah, so yeah, spot on. So that's an area for looking at. And as financial planners, yes, we'd like to try and help if we can. So we're going to move into that shortly. But at the moment, the only good thing I think we've seen so far is the fact that sales are increasing significantly. Yes. So all the profit margins are going down. This section wasn't that revealing. And this section here, as Ernst pointed out, it looks as if he possibly has got cash flow problems. So sales might be increasing, but the cash flow doesn't look good. So there's definitely some problems somewhere. So let's continue with the other ones, and then we'll have a fuller extract on the cash flow position. Now, asset efficiency is a ratio that you'll hardly ever see work, but I still think it's quite a good ratio to calculate. Let's look at how you calculate this. So if we look at the asset efficiency you'll see that's the sales of the business divided by all of the assets in the balance sheet. So that's the current assets plus the fixed assets. Now, why I like this ratio is because it shows to me the total asset utilization in the business. So we've got all these assets in the balance sheet, whatever business we're looking at. And then if we look at all of those assets relative to the sales of the business, the revenues of the business, we can see how many times the business is turning over all of these assets. Some will be very slow and low, and some will be quite quick, but it's an interesting figure to work. So let's just do that on this particular business. So what we need to do is we've got the sales figure in year one, and then we're going to look for all of the assets in the business. So we've got current assets, look, at 285. And then further down, we've got fixed assets at 51. So the total assets in the business will be 336, is that right? 336,
Mhm.
yeah, 336. And then we're going to get the sales figure, use that as a numerator, and then divide that by 336, and we'll see how many times it's turning over. So sales in the first year was
It's three.
900,000. It's approximately 3. Yeah. Let's have a look.
Sorry.
Yeah. So it's 900,000 divided by 336. Is it? Yeah, 336. Now this time I'd use the decimal point, but I'd use it to the, one space. So I make it 2.7 times. Yeah, 2.68. Thank you. Yeah. So we call that, yeah, let's make it 2.68. And then do it again for year 2 and year 3, and we'll get the trend. So 2.68. So have a look at year 2 and year 3. Gosh, we've got some different answers coming through. Yeah, so we got confirmation from Nikita. Year 2 is 2.6, which agrees with Shakira. 2.6. And then year 3. Nikita's giving us year 3 at 2.4. Anyone confirm that?
That's correct.
Thanks. So the asset efficiency then is, we got 2.68 or 2.7, you could call it, and then 2.6 and 2.4. So is he getting more efficient at using his assets or less efficient?
Less efficient.
Less efficient, yes. So it's another deteriorating trend. And again, that would provoke, a question on why this is happening, because as you pointed out earlier, Katira, his sales are going up, sales are going really well, but we saw cash flow issues, and we're now seeing the efficient use of asset issues as well. So although, you're very positive this time and also 3 weeks ago that we want to try and help this business, you know, there's some, you know, some pretty severe underlying problems that we seem to be finding so far. So just a few minutes more and then we'll take a break. We take a 10-minute break after 1 hour, just so we can stretch our legs, move around a bit, make a cup of tea or coffee or whatever. So let's just try and get these, the interest cover figure, and then we'll take the break. So interest cover, using the interest cover from the income statement, and a bit later we'll look at the cash flow coverage aspect. But from the income statement, the income, start again. From the income statement, the interest cover is the traditional approach of profit before interest and tax divided by the interest that's paid. So, for example, in year one, it would be 33 divided by 8. So I'll just put that in, 33 divided by 8. And that gives us 4.1 times interest cover, which is pretty good because traditionally, all those years ago, you know, we'd look for 2 times interest cover and hoping sometimes you might get 3 interest cover. But of course, during the pandemic, lots of businesses haven't even been able to cover their interest, you know, so some of these benchmarks have gone out of the window. So can you do year 2 and year 3 interest cover? It's there for you to make the calculations. And we'll just see how that comes out and then we'll take a short break. So year 2, we're offered at 4.1. And then year 3, it gets worse. It's 13,000 divided by 11,000. So that's going to be 1 point something. And we're offered 1.2 by Nikita. Anyone confirm the 1.2? Yep, 1.18. Thanks, Sakira. Okay, so what we had was in year 1, you know, a good interest cover for the bank lending bank position at 4.1, and then 4.1 again in year 2. But again, Shakira again, Katira in year 3, when we saw that big jump in sales of almost 24%. Look what's happened, the lending banker position, the interest cover has collapsed to 1.2, but it's still covered, but it's, you know, gone down significantly. Okay, we're just about on the hour, so let's take a 10-minute break. We'll reconvene at 10 minutes past the hour. Then we'll work out the debt gearing, that's the debt to equity ratio. And then we'll do some work on trying to pinpoint, you know, the extent of his cash flow problem. So I'll just mute and go off picture as well for 10 minutes. Okay, everyone, let's continue. So we're almost there with the mathematics on this ratio sheet. So there is a ratio leverage, which is a wide measure of liabilities that we can look at. But for the moment, I'd like to progress to the final one on the sheet, which we've got entitled debt gearing. Now, this is said to be the favorite bankers ratio worldwide. Some people call it the debt to equity ratio. Some people call it debt gearing. Some people call it gearing ratio. So let's have a look at that. So the calculation is a little bit tricky in that what we're looking for is the interest-bearing liabilities, because we want to differentiate this from the leverage ratio. So if you look at the calculation there for gearing, you can see what I've stated is the total interest-bearing debt. Now, the emphasis is on interest-bearing, so we pick up actually what is the true debt. So for example, creditors in the balance sheet are a liability, but generally there's no interest charge. So we're not classifying this in the gearing calculation. So let's take a look at this together. So we need to go to the balance sheet. Here we are. So in the balance sheet for year one, what we're looking for is the total of the interest-bearing liabilities. So let's work our way through this. So year one, if we go into current liabilities, supplier credit, no. Now hire purchase, that's like installment financing. So that would bear an interest cost. So we've got 2,000 to put into the calculation. The bank, yes, at 90,000. That would be charging interest. Tax, no. Now, directors' loans, this is a tricky one because we'd have to check the documentation or ask the accountants, is it interest bearing? If it's like a steady amount, as you can see there, it's unlikely it's interest bearing. So it's a form of capital into the business by way of a director's loan. So what we've got so far is 2 and 90, so that's 92. And then we need to go down to long-term liabilities, and there's some long-term installment financing of 6. So I make the total of the interest-bearing liabilities at 98,000. So that's the debt figure for the gearing calculation. And we're going to divide that by the equity base. Now, the equity base can again be slightly confusing depending on the structure of the business. But you can see in this business here, the equity base consists of the share capital at 20,000, plus there's been some retained profits there of 60,000. So the equity base here is being called the shareholders' funds of 80,000. So the calculation for the gearing is 98,000 divided by the shareholders' funds at 80. And that gives us 123% geared, or if you prefer 1.2 to 1, it depends how you like to calculate this. It's done in both ways. I personally prefer it as a percentage because I think it makes more sense in conversation with the client. And you've seen, from the relationship module to how important these things are. So 123% geared in the first year. Now have a go at years 2 and 3, and we'll see what you get for that. So don't forget you're looking for the interest-bearing liabilities and then divided by the shareholders' funds. Year two, 117%. Thank you. And year three looks worse at 150%. Can you just give us the third figure in that? You've got 1.5. Is it 151 or 152 or 153? Or is it exactly 1.5? Thanks, exactly 1.5. So it's 150%. So the gearing calculation, the debt to equity, if you prefer to call it that, is 123%. And then it drops slightly to 117%. And then in year three, it gets a lot higher to 150%. So is that getting better or worse? Probably need to call on Ernst for his initial comment on this. Debt to equity ratio, gearing ratio, 123, 117, and 150%.
I would say it's getting worse.
It's definitely getting worse, yeah, much more debt relative to the shareholders' funds or the equity base. So he's borrowing more. Why do you think he's borrowing more than Ernst?
I would go right back to the cash flow.
Exactly. Yeah, keep talking. You're doing well.
Yeah. I mean, that's one thing, but
Uh-huh.
I would say cash flow. He's heavily leveraged. I'm not
Yep.
sure why, but
Yep.
he's more comfortable in borrowing more
Yeah.
to sustain business.
Yeah. Okay, so let's pick up on the leverage ratio. So if we look at leverage, you can see the calculation for leverage. And this is not to be confused with the American definition of leverage, which is more to do with operational aspects. So this is a balance sheet leverage position, where this time we're going to take all of the liabilities. I'm sorry, it's split across the 2 pages here, but it's all the liabilities divided by the net worth position or the shareholders' funds position that we've just seen. So it's the same figure that we've been using for the bottom end of the calculation, but the top end is going to be different. So we're looking for all of the liabilities in the balance sheet. So let's have a go at this. This is the final one. So in year one, I'll do year one with you, then you can have a go at year two. So all of the liabilities this time. So we've got total current liabilities of 250,000. And then we've got long-term liabilities of 6,000. So the total liabilities are 256,000. And we're going to divide that by the 80,000 that you see there. And that's going to give us the leverage as a percentage. So 256 divided by the 80. So I get 320% leveraged, which sounds a high figure. And let's see if you can do year 2 and 3, please. Year 2, 330%. Yeah. Or 325, 330, yeah. And then year 3, we're offered 450%. Someone confirm year 3, please.
That's correct.
Thanks, Ernst. Okay, and so while I've got you on mic, so what do you think about that leverage position?
As a banker, I don't like where he's at.
No, it's very high, isn't it?
Yeah, to me, it's scary to be honest with you.
Yeah. So it is scary because he's borrowing more from the bank, as we've seen at 123, progressing up to 150% of debt to the shareholders' funds. And then this wider measurement, which is why I like to work both, because occasionally you will see a business where you calculate the debt to equity and you think, oh, that's not looking too bad. But what they're doing actually is borrowing from other sources, and you might not flag that up, but you will if you work this wider measurement of leverage. So you can see, look at the leverage comes from 320%, which is high, to 450%. So this business is under a lot of pressure, despite the fact, we keep going back to this, and Katura will keep mentioning it again, despite the fact, that his sales are progressing very well. So what we're going to do next is we've just got a little bit more mathematics to do, which is to extract a cash flow worksheet. Now, what I have to say to you in advance of doing this is quite a tricky little exercise. And what I need to say to you is, in practice, you would not be expected to do this. It's a job of, the business accountant to extract and plan the cash flow. But as financial planners, if we can come up with this cash flow worksheet, which you'll see is a revealing summary of the cash flow, and you can do it on this business clothing imports. You could do it if you wanted, on the Atlantis Hotel Group. You could pick a favorite company off the internet, very large company, and have a go with the cash flow worksheet. And it should give you a good summary understanding of the cash flow movements in the business. So to do this, we're going to need to move forward in the documentation, quite a long way actually, until you come to this cash flow worksheet. I've just gone past it. We have this 2 there. Now that's, yeah. Now that says, there's a mistake on this. That says forecast. Ignore that, because what we're actually doing is analyzing the cash flow of the business that we're actually looking at. Now, what we're going to do here is we're going to look at the cash flows that have been stated by the accountant, and we're going to transfer them into this. Now, you could say, well, why do we need to bother doing that when the accountant's already presented the cash flow, in the figures that we're seeing? So my answer to that would be, this worksheet will give you a much clearer position of what's actually happening with the cash flow. So can you see, working your way down the cash flow, we've got the entry point there, then we've got spendings out on cash flow, and then line D is a very important line, because that's the line that will give us the net cash flow, which Ernst's quite worried about, and I know some of you will also be worried on this business. So will this net cash flow before financing be negative or positive? And that's what we're looking for. Sometimes people call it cash positive or cash negative. Some people call it a cash generator or cash consumer. Yeah. So, and then this next section is how the cash flow is balanced up. So just ignore that section for the moment. What we're going to head for in the beginning is to try and pinpoint these cash flows so we can get a better idea of what's actually happening with this clothing imports business. So what you need to do, if you can, is try and open it on a split screen basis, because we're going to need to get these figures into this. So let me just try, go back to the cash flow. Okay, so here's some of the cash flow figures that the accountants produced. So at a glance, some of you may be really sufficiently skilled to just look at this and make sense of the cash flow. But I think it's a bit of a jumble the way this is presented, and we want to transfer these figures into the cash flow format. So what we need to do is look at the cash flow worksheet and then go back into the case study. Okay, now the cash flow worksheet starts with the profit before interest and tax, and then we're going to add back depreciation and any other non-cash items. Now the problem here is this presentation starts with profit before tax. So what we've got to do is go into the income statement to pick up the profit before interest and tax. In year one, there it is, 33,000. And then what we're going to need to do is some of the movements will be between years. Now we don't have the preceding year to year one, so the cash flow analysis that we're going to be doing will be based on year two movement from year one, and then year three movement from year two. So our entry point for the cash flow analysis would be the profit before interest and tax in year two. So I'm going to put this on the cash flow worksheet. $34,500 is the starting point on the worksheet. And then we're going to add on the depreciation and any other non-cash items, which is where we're going to need to move in to the extra figures provided by the accountant. There's depreciation, look, $2,000. So on the cash flow worksheet, what I've got so far is $34,500 plus 2 to give me $36,500. Now the next section, we have to be really careful on the worksheet, and the key word on the worksheet is movements. So these are not the actual figures, these are the movements in the figures that's going to affect the cash flow. Now, what we can do to start with, you can see there's on our worksheet, there's movement in stock. So what we could do there is go into the balance sheet. And don't forget, we're looking at year two movement from year one. So if we look at year two inventory, $190,000, and year one, $135,000, you can see the movement in stock is $55,000, yes? Now, the next question we have to ask ourselves, try and think again as the business owners, we're owning clothing imports, and this should help us figure it out. Now, there are mathematical formulas for driving this out, but if you can figure it out from a logical basis, it will really, really help you going forward, because you get a better understanding that you can use within the conversation. So my question is, as clothing imports, if our stock is increased from 135,000 to 190,000, which means we're carrying an extra $55,000 of stock, is that a use of cash flow or a source of cash flow? So here's a tricky question. as business proprietors, if we are increasing our stock, will that mean we're using cash flow to increase the stock or not? Someone have a go. You can only be wrong. A use, Nikita, very good. Yes, it's a use of cash flow because, you know, to get that extra stock, you know, we're gonna have had to have used cash flow to finance that extra level of stock. So in our cash flow worksheet, where you've got movement in stock, the figure to put in there is $55,000. But because it's a use of cash flow, we've got to put that in brackets. Now, when we look at some of the modern cash flow statements that are now being generated, they're much, much clearer than they used to be and much clearer than this case that we're looking at, because the accountants under the modern presentation, when the figures are positive, it's a positive cash flow. And if it's cash flow going out of the cash flow, you'll see it in brackets in the cash flow statement. So that's what we're going to be doing on our cash flow worksheet. Okay, the next figure is the movement in debtors. So in the balance sheet again, debtors 150 increased to 170. So there's a movement of 20,000. So as business proprietors, we've now got 170,000 of receivables due or debtors due, excuse me, which is increased from the previous year. So will that be a use of cash flow or a source of cash flow? Now this one's quite tricky. Anyone want to volunteer?
I would say source.
Well, Ernst, it will be a source when we collect it in, but for the moment, the problem that we've got is there are more people owing to the business, yeah? So as business owners, we've had to finance that extra level of debtors or receivables until we can collect it in. So actually, it's a use of cash flow. So we've had to use cash flow to finance the increased level of debtors. We've had to use cash flow to increase the level of stock. Now, I know it's a bit tricky the first time you do this. So back to cash flow worksheet. Movement in debtors is 20,000, as we saw. And it's in brackets because it's a use. Now, if you're not too sure, you know, as we progress, don't worry, because with the cash flow, the good thing about the cash flow is we got to balance it. So if we made, you know, a mistake on the way along, we won't balance in the end. So we'll have to backtrack and try and figure out where we went wrong. So the next figure is movement in the creditors. So let's take a look at that. Now the creditors, you can see, look, in year 2, 180,000, year 1, 140,000. So there's a movement of $40,000. And as business owners, we owe more people by $40,000. So is that a use of cash flow or is it a source of cash flow to the business? It's a source. Thank you very much. So again, it's quite tricky. So what they've actually done, clothing imports, they've actually got more credit, you know, from the suppliers. So that's actually a source of cash flow of 40,000. I should stop at this point and say that in the financial planner program, this cash flow analysis extract is probably one of the most tricky things you'll do over all of the 6 modules. So if you just kind of be patient with me, and then, you know, you can take another look yourselves when you have a few moments to maybe try it on a different business. Now, on this particular case, going to the worksheet, we haven't seen any prepayments, we haven't seen any accruals, and we haven't seen any sundry items. So that box that we're looking at, that movement box, which we're calling a subtotal at B, change in working investment. Some people call it change in working capital. Some people call it change in the working assets. So what we've got is 55,000 negative, 20,000 negative, and 40,000 positive, which gives us 75 minus 40, 35,000 negative for line B, which is going to go in brackets there. So hopefully so far you've got your entry point line A, which we call the gross operating cash flow, $36,500. So he was off to a positive start. But the problem is within this working capital cycle, this cash flow cycle, he's actually used $35,000 net. So we've got to take away that $35,000 from the 36.5, and you're going to have a net operating cash flow of $1,500. So this is looking quite bleak, because you can see the next line that's going to come up is interest expense. So let's look at the interest expense. And there it is in year 2, look, 8,500. And that's going to be cash out, you know, because you've got to pay that out of the cash flow. So it's in brackets. Let's verify that. Where has it gone? Oh yeah, you see, he's gone in at profit before tax. So that's already been treated, yeah. But we have to stick with our analysis, 8,500 interest expense. Now remember when we worked the interest cover, and I said there's 2 ways of doing it. One's from the income statement, and looking at your ratio analysis sheet, interest cover was 4 times, 4.1 times, 4.1, and then 1.2. But when you look at the cash flow interest cover, you know, which we don't throw away the old method of the interest cover from the income statement, we keep that. But then what we like to supplement our analysis with is the cash flow interest cover. What coverage has he got for the interest payment from his cash flow? And you can see straight away he hasn't got any, has he? Because we had a figure of 1,500 on the worksheet for the net operating cash flow. So NOCF was 1,500. But the interest was 8,500. So let's continue. There's no dividend paid on this example on the worksheet. There is some long-term debt, but as far as we know, there's nothing repayable in less than 12 months, which it says on the worksheet there. So line C, the net cash flow after debt servicing, we had 1,500 positive and 8,500 negative. So we've actually got a position of 7,000 negative. Is everybody okay so far? Has everybody got 7,000 at line C?
Yes, I got it.
Negative. Great. So it's working out just as Ernst was telling us. Now the next box is fixed asset expenditure or disposals and taxation. Now this is where it's quite tricky, because in the accountant's presentation, if we look at the cash flows, he's got purchase, and then he's got sale in brackets of fixed assets. Now, to me, this doesn't make much sense, because if you sell a fixed asset, it's going to generate cash flow, excuse me. And if you buy a fixed asset, which happens in the next year, it's going to use cash flow. So I don't think these brackets and lack of brackets is correct. So what we've got to do is stick to our own logic and continue, because we're going to have to balance it. So what we've got then is fixed asset expenditure or disposal. Well, he sold a fixed asset for 1,000. So on our worksheet, that's $1,000 positive. Then we know tax. When you pay tax, it's going to be coming out of cash flow. And again, look, there's no brackets in this accounting presentation, but we know it's $8,000, so we put that in brackets. So on the worksheet, we've got 1,000 positive and 8,000 negative. So we've got 15,000 negative and 1,000 positive. We've got a negative 14,000, is that right? As the net cash flow position. I'll just stop for a minute while you all catch up. Everybody okay on that? Negative 14, line D.
What did we do yet, Mr. Chaplin? Sorry, I'm having
Hello,
issues
yes.
switching screens. I'm sorry. What did we do yet? We did the 8,000
Yeah,
negative
yeah,
and
and tax, yeah, and 1,000 from the sale of the fixed asset, which he's actually got in brackets, but that's got to be wrong, because when you sell something, you know, it will generate cash flow. So in that section on your worksheet, you'll have 1,000 positive and 8,000 negative for the tax, yeah? So did you have, at line C, did you have 7,000 negative?
7,000 negative, yes.
Excellent, so you're right so far. So you've
Okay.
got so you've got 7,000 negative, then you've got another 8,000 negative for tax. So that's 15,000 negative. Then you've got 1,000 from selling the car. So your line D, the net cash flow before financing should be $14,000 in brackets.
Okay, yes.
Negative.
Thank you.
So this has really pinpointed Ernst's earlier comments and your other earlier comments. So I'm not just favoring Ernst on this. That you know, we were worried about the cash flow. Why? Because he was collecting his debtors in slower. The stock, the inventory turnover was slowing. He was paying his suppliers slower. So we were quite worried about the cash flow aspects. And we also saw the debt to the bank increasing and the leverage increasing. So we're worried about the cash flow. And using this cash flow worksheet technique, we can actually pinpoint it. So you can see, yes, he's got a cash flow negative position. Now he's got to finance that for the business to continue. So that's where this bottom section comes in. Now this bottom section is quite confusing, again, in the accounting presentation. So you've got to try and like figure it out again in a logical manner. And I know I keep saying this throughout your financial planner program, but that's, you know, one of the best skills you can ever have. It's okay being, you know, whizzy mathematically, but you know, you need good common sense to figure out where this is going to fit in. So how does he balance this 14,000? Well, you can see it starts off by increasing equity. Well, let's look if there's been an increase in equity. So that's looking at the share capital position in the balance sheet. No, see, it's 20 to 20. So there's no increase in equity. So just put a dash there. Short-term debt, well, that's the balance sheet. Let's look. Short-term debt we're looking for. Now the hire purchase stayed the same. There's the bank. Look, it's gone from 90,000 short-term debt to 105. So there's been more borrowing from the bank of 15,000. That's the difference. So 15,000 goes in onto that financing box that we're looking at. And then let's look at the long-term debt. Now, long-term debt's actually gone down slightly by 1,000. So there's a use of cash flow there. So we've got that 1,000 in that box in brackets. So what we've got is 15,000 positive because he's borrowing more from the bank, and 1,000 negative because he's paid some long-term debt down. And if you take the 1,000 away from 15, you're going to get a movement of 14,000 positive by way of the borrowing, and that eliminates the negative of 14. So the net movement in cash will be 0. Can you see that? Now the bottom bit's a bit tricky. So what we're trying to do is look at the financing by way of equity and debt, and then see how that balances out with the net cash flow on line D. Let me try and get this on the screen. Okay, can you see this on the screen, the cash flow worksheet with some typed figures in? I hope. Anyone, can you see the cash flow worksheet on the screen?
Yes.
Great.
Okay.
Yeah.
Great. Okay, so here we go. Look, this is what we've been discussing. 36,500 coming in there. You know, then we had that change in working investment. So he's used a hell of a lot of cash within that working capital cycle. You can see there. He's only got $1,500, but the bad news is he hasn't got any cash flow to pay the bank's interest. So what that means is he's going to have to borrow money from somewhere, you know, either from the bank or long-term debt to actually be able to pay the bank's interest charge. So that's a pretty bleak situation. Then he's 7 negative there, and then 14,000 negative at the bottom. And this is the key line. This line D is the key line that we need to figure out as financial planners, whatever business we're looking at. Now, we might not be able to get the figures, you know, immediately from the client, but what we can do is say to the client, you know, well, can you prepare the cash flow statement for us so we can see what's happening with the cash flow position? Because I repeat, and Miguel will confirm this, you know, you're not expected in the exam to derive a cash flow statement, but what you are expected to have an understanding of the cash flow. So that's what this is all about. So clothing imports, Ernst and you other people, you are worried about the cash flow. And what we've shown is the cash flow is bleak, and the net movement in cash, can you see at the bottom there, put an asterisk, reconcile with source documents. Now, this is really good news for us, because what it means is when the accountant does the statement of cash flows, and you'll see this, you know, in businesses that you can look up, which are a bit larger, or download one from the internet, you'll see the accountant at this stage has got to balance the cash flow with the cash flow movement in the balance sheet. So what we've predicted, look, is a 0 movement, because we had 14,000 coming in there to balance the 14. So the movement in cash is 0. Now, all we need to do now, and I can't switch screens that quick, but if you go into the balance sheet and look at the cash position in the balance sheet, can you see right at the top of the balance sheet, the cash position? What is it?
Zero.
There's no, yeah, Shakira, there's no surprise there. He's got 0 cash. And what happens in the next year? He's got 0 cash. And the next year he's got 0 cash. Well, we know the reason is because, you know, he's using cash flow as we've been predicting. So what I've done, look, is I've calculated the next year, so you could copy this onto your worksheet. So let's look at the next year. Now the next year's entry point is not quite as good as it was the previous year because he's only got profit before interest and tax of 13,000. So his cash flow is not off to a very good start because his gross operating cash flow is only 15,000 as compared to 36,000 the year before. Let's see what happens in his working capital cycle there. Well, 67,000 extra stock, 60,000 extra receivables, and he's borrowed a huge amount extra from his suppliers, 100,000. So the net position there is 27,000 negative. So his net operating cash flow is worse than the year we were looking at. It's 12,000 negative because that's the 15 minus the 27. And then this time he's got interest to pay of 11,000. So there's no interest cover, whatsoever. And once again, he's going to have to borrow money from somewhere to pay the bank their interest cost, which is an alarming situation. And I liked his comment when we looked at the leverage and the gearing ratios, and he said, it was pretty worrying there. And you can see the effect here. So 11,000. So that gives line C of a negative 23,000. This time there's a fixed asset expenditure, despite the fact he's got no cash flow. He's got 23,000 negative cash flow, and yet he spent on a fixed asset 7,000 and tax to pay of 5,000. So that's another 12,000 negative. So line D, the bottom line cash flow, where we ask ourselves, is the business a cash generator or cash consumer? Well, look at that. It's $35,000 negative. So where the hell is he going to get that from to balance his cash flow? Well, let's take a look. Short-term debt. So go into the balance sheet. Look at the bank position. I'm not going to switch screens, but you can do that. Look at the bank position. It's 105,000. No, it's not. Yes, it is. Bank 105, increasing to 138. So he's taken an extra 33,000 short-term debt from the bank. And then let's look at the long-term debt. Long-term debt further down the balance sheet. Yeah, long-term debt looks increased from 5,000 to 7,000. So he's taken 2,000 extra in the debt there. So you can see this time there's no increase in equity again because the share capital is the same. So the whole of the whacking 35,000 negative is taken from borrowings, and this explains why his debt gearing's been increasing and his leverage has been increasing, and he's got a movement in cash again of 0. So very quickly, that's a cash flow analysis which pinpoints what we've been saying all the time. Now we've only got kind of 5 minutes left, but let's just now try and have a general discussion on, and we already had comment a number of times from Katura. So let's start with Katura. So does this cash flow analysis help you in your original desire to help the clothing imports business, or does it just give you a bit more focus on, the kind of areas you need to discuss with them? Put you right on the spot there.
Yeah, I won't completely give up on Mr. Clothing, but
You will or you won't? Did you say you won't?
I won't completely, but he really has a cash flow issue he needs to deal with.
He
He's
certainly has.
borrowing.
Yeah,
Yeah, he's borrowing too much to try and sustain the business,
yeah,
and his inventory is not turning over quickly enough.
correct. Yeah,
So yeah, yeah, no, I changed my mind.
yeah, yeah. I mean, you could say there is still an element of hope. Why? Because in a very competitive market, he increased his sales up to 1.3 million, didn't he?
Yes, but
So
I
yeah,
keep going on that. That's all I was holding on to.
yeah,
But when you combine that with these internal issues,
yeah,
he's not collecting his debt on
yeah,
time.
yeah,
It's just a common. It looked like management though.
yeah. It is management. Very good. Anyone come in
This
and
is
help?
how many businesses fail, management.
Yeah. So anyone come in to help get you on this? So what we've identified then is, and it's what Ernst said earlier, in his experience, somebody who's good at sales might not be so good at collecting in the debtors. Well, here's an example, I think, of that. And they're also not very good at managing the inventory by the looks of things. They're not very good at managing the cash flow. So really, he probably is an out and out salesman and would verify that, having a meeting with him, and we could go to the warehouse and take a look at the inventory. But as financial planners, our objective is to try and help if we can. But this is going to be a tough one, isn't it? This is a tough call, this one. Somebody else come in? Yeah.
Yes, I had a question that I
Sure.
dropped in the chat that I thought would also impact his movement with cash, but it'll probably put it in a negative position. But the director's loan of 10,000, wouldn't that
Yes.
affect the equity?
It would if it was capitalized. So that's a very good accounting question. So what we're seeing is a kind of quasi capital position.
Okay.
So one of the parts of the advice would have to be a discussion with the accountant. This 10,000 shouldn't be sitting in there by way of a loan. It needs to come in to the capital base of the business. Yeah.
Right.
So that 10 needs to be moved. But for the moment, you can see it's 10, 10, 10. So there's no hint of it being repaid. If it
No.
was repaid, that would have to be repaid out of the cash flow, which would make the cash flow even worse.
worse, yeah.
So what we're looking for really would be the capitalization of that 10,000. Yeah. So any
So
other?
I
Yeah.
definitely agree with Katura that it's
Good.
more so a management
Yes.
issue internally.
Yes.
And so if he was able to restructure that and get that going, especially with his collections, he can see his way out of this issue because
Yeah.
definitely, as you say, there's revenue being
Yeah.
generated. So
Yeah, there's a gross top line being generated, but everything
he
else
has to
after
learn how to manage
that,
his,
everything after that's like a
bottom line.
nightmare, isn't it? Yeah, I mean you
Yeah.
couldn't make up a worse situation. So do you think then what he might need simply is to recruit somebody
Yes.
if he was, or outsource? Someone mentioned outsourcing earlier. He hasn't got much. He's got no cash flow. He's got negative. So maybe you can't afford to recruit somebody, but maybe you could outsource it somehow. And what would be a key area to outsource or recruit somebody to do? Do you think what would be a good starting point in this
Definitely
business?
collection.
Collections, definitely. Yeah, collections will give us a key start. And the
And
more
then
they
that
can,
person could
yeah,
also negotiate his credit terms so he could leverage that more.
the credit
Trying
terms.
to collect.
As well, yes. So, yes, somebody coming in by way of a credit controller or outsourcing to a credit controller. And I have to say, from experience, Ernst mentioned some of his experience. I have to say, from experience, generally ladies are much better credit controllers than men because ladies can be more kind of direct and objective on the collection of debts, being my experience. And you can understand how he might be quite weak at collecting the debts because his focus is on selling, isn't it? And it's very much a different discipline. The collection, the rigorous activity of somebody mentioned earlier, interacting, with these debtors, interacting, with the debtors by way of the collection. That's not going to be his forte, is it? When he interacts, what he's trying to do is sell, and sell more of the articles to the stores. So it's not really, this is what you're going to find, so we had this mindset situation with Jane Brown, where she was thinking the whole world was wonderful. She met this new man, Mr. Martin, she was getting the divorce monies and they were going to buy a timeshare in Florida, and everything was euphoric. Edwards, he was in a bit of problem. We tried to help. Clothing is much more extreme problem, but we do our best to try and help him if we can. But obviously we can't be, collecting the debtors in, but certainly you need some pointing in that direction. Any other ideas on the clothing inputs?
Something
Yes.
that just came to me also is
Yeah.
you would want to audit his persons who he has to collect from, because he might be continuing to increase or give the same people inventory who haven't paid him
Very
over
good. You know
a
what?
period of time.
Yeah, in the bank, we'd call this the bad debt position, wouldn't we?
Yes.
Our doubtful debts. Yeah, very good. Within that huge debtor collection figure, are there some within that that are not collectible? And that's got to be pinpointed as well. Yes, very good suggestion. Now, what about the selling strategy? Because again, I think it might have been Katura weeks ago that said he could alter his selling strategy slightly. Can you remember what that was? Or was it Shakir? I'm not too sure. How's he selling at the moment? He's selling to retail stores, isn't he? So what's an alternative to that? Which everybody's doing at the moment. When you buy, you always buy from the retail store. So there's a clue.
Online, he
Of
could
course,
include
online.
online
Yeah.
shopping.
Yeah, can he do some online? Yeah, can he set up an online strategy to run alongside his existing business? I know it will take time to do, but it's an idea, yeah. Katura, was it you said that a couple of weeks ago, 3 weeks ago? 4
Yeah, I
weeks.
keep saying he would do better. He needs to change his suppliers.
Yeah,
He needs to find new suppliers, cheaper supplier, and
cheaper
better quality.
supplies. Yeah,
Better quality, because it seems like someone said antiquated. So he
Yeah.
needs to revamp his business
he
completely.
does. Very good.
And he's good at sales, so he'll be good.
Yeah.
His transition will be great.
Yeah, so we're getting to it now. He's got to revamp the business. That's very good. He's got to revamp his collection strategy, revamp looking at his selling techniques, who he's selling to, looking at his customers, which of them could be doubtful that won't be going to pay, looking at the suppliers, very good idea, to get right into the quality of the supplies. Can he find cheaper suppliers? He's buying more recently from London, and you all know London's very expensive relative to the Far East. Does he need to return more to a Far Eastern profile for the supplies? Because if you look back a couple of years, he was making reasonable profits, wasn't he?
Yes.
Yeah. So what's the change? Why, why, Mr. Clothing? 2 years ago, you were selling $900,000 of clothes, and you made $25,000 after tax, yeah, or $33,000 before tax, and yet you're now selling 1.3 million of clothes, and you're making $13,000, before the tax position, yeah. So wow, you've got to do a deep, what we call now a deep dive into this business. And good luck as financial planners if you get this type, landing on your plate. It's going to be tough. But as Katira said from the start 3 weeks ago, there is a glimmer of hope, because he's increasing the sales of his product. So maybe there is an underlying business that we could help to try and save. Okay, well, we've run over slightly. I hope you don't mind. So that's it from me for the moment. There's some follow-on notes you'll see about business startups, trying to help people with their business plan, etc. And then I'll hand you back over to Miguel and wish you all the best with your financial planning, and hope you got a lot out of the clothing imports case, because there's a lot in there. But it shows the power of the analysis, yeah, the power of pulling out these ratios to see how the business will perform. So, Miguel, are you still there? Or have you gone for lunch?
Yes, sir, I'm still here. I'm still
Hey,
here.
still there, right?
Still
So
here.
you can close us off. We ran a bit over.
Yes. So thank you, ladies and gentlemen. That's your modules 1 and 2. As I said, you have a new schedule. Your next class is this Thursday at 6:30 p.m. Mr. Sam Wilkinson, and please, by the end of the week, come and collect your module 6. Okay, come and collect your module 6 from the office. With all that said and done, folks, have a wonderful weekend. I guess I'll see you all on Thursday.
Okay, thanks.
Okay.
Thanks very much, Miguel. Thank you, everybody. Thanks.
Thank you and good afternoon.
Yeah, thanks.